Is now more than ever the time to expand well beyond the tech stock horizon? Let's get right to the floor show. We bring in Mercer Global Chief Investment Strategist Rich Newsom. His company advises clients who have more than $16 trillion in assets. And Main Street Asset Management's Chief Investment Officer, Aaron Gibbs. Rich, that selling reaction to the ASML news sure looked hair-trigger. I mean, the slightest sign of pressure and investors hit the sell button on tech names. And where did they go? They went to the Russell 2000. What is that telling you?
I think clients are very conscious that we're in a Goldilocks moment for the global economy. Things look really good. We hit new all-time highs on Monday. We're flirting with new all-time highs today. But there's a fragile sense of confidence around that and a lot of uncertainty about how real the AI and digital trend are. They're clearly real. They're clearly impacting the real economy. But most of that earnings is out in the future. And so a minor change in expectations about the growth rate in earnings, the trajectory of earnings, can have a big impact on stock prices in that sector. What we're seeing from our institutional investor clients, that $16 trillion you mentioned, is a focus on diversification in advance of the next crisis, because they're just not sure that digital and AI can continue to move up and up and up and lead all over the other sectors. So we've seen some broadening out already, as you mentioned.
That is true. And Aaron, if we have investors watching who haven't yet begun to expand their portfolios, I don't want to say rotate, but where do you see the real chance for them to do that and catch some upside?
So one opportunity I really like right now is insurance. They were really beaten up. There was a lot of negative sentiment around all those hurricanes in Florida, still making headlines. And they normally trade pretty much in line with the banks. They trade at similar valuations, and their returns are very similar. And there's been this bigger and bigger spread as banks are beating estimates and getting higher, and insurance are staying below. And so right now there's about a 5% spread, which I think will be removed within 4 weeks as soon as they start reporting. So this is like an easy 5% you can make over the next 4 weeks. But overall, it's a great defensive. We see the banks being better positioned and better leadership, and insurance is part of those financials, is part of that story.
Except they're not as highly valued. I might not say overvalued, because some of the banks are trading fairly, but if you look at the PE ratios of insurance names, and we just picked out three, among them MetLife, Prudential, Bright House, around 9.9%, 9.4 for Prudential, 3.5 for Bright House. And if you compare those to some of the bigger bank names and bigger financials, even say, for example, Visa's at 28 forward PE, Amex 21, Morgan Stanley 17. You got to look at that valuation.
Right, absolutely. And part of it is because they make most of their money off of just the net interest. And so as yields become more normalized and we see, lower rates lower and higher rates higher, they're going to make more money and you're going to see higher valuations. So you can make money two ways. One, off of just the simple low valuation, and two, we just actually see some potential more earning growth for them. More
earnings growth. Rich, you mentioned that we are very close to record highs for the Dow, the S&P, and the NASDAQ. And here we have the Dow Jones Industrials up 322. Again, they need to be up 325 to erase yesterday's loss. We were there at the top of the show. We're not quite there yet. But that said, we're very, very close. David Einhorn of Greenpoint Capital, the big hedge fund guy, came out with some very interesting points in his letter. And basically, he said valuations are at nosebleed levels, and that Warren Buffett's selling a lot of his shares of, just say, Bank of America and some of the other names really is a signal to David Einhorn that you got to be careful here. The recent stock sales show it's time to pare your equity positions and exposure. What do you think about that?
I have a lot of sympathy for the idea that valuations are stretched, and so our institutional investor clients are looking for diversification. But rather than get out of equities, they're finding it in the emerging and frontier markets, looking past India, taking a call on China, but looking past India and China to the rest of emerging frontier, where the price-earnings ratios are less than half of what we have in the U.S. And another way of putting that is for every dollar you put into those markets, you're getting twice the ongoing earnings. Or a third way to put it is that the U.S. stocks would have to deliver twice the earnings growth as those emerging frontier economies just to keep up. And those economies are benefiting from the U.S. going into a rate-cutting cycle. Emerging and frontier markets aren't one-size-fits-all, but many of them import U.S. monetary policy either by pegging their currency to the U.S. dollar or by half of emerging market debt is issued in hard currency, mainly the US dollar. So they've had this tight US monetary policy, whether that made sense for their local economy or not. They're going to be big beneficiaries of the US continuing to have strong economic growth so that they can export to the US, but also a looser monetary policy, which they effectively import.
We look at all different areas of the markets, Aaron, and there's some side window trades that people want to know about. And when I say that, it's that they're not overly populated, but you're talking about uranium, for example.
Yes.
Well, uranium is needed for nuclear power plants.
Right.
And these mini nuclear power plants, we've covered them here, have become very much a thing. And then you've got the biggies like Constellation Energy Group restarting 3 Mile Island. In fact, there's actually a headline about that right now. The transformer is going to cost to reorder the main power transformer for 3 Mile Island's nuclear reactor, which is going to reopen in Pennsylvania, will cost about $100 million. This is big chunks of change. People want to know, how can I catch that tail?
Right. So there are a couple ETFs that are really well diversified with uranium miners. And so it's an interesting play because it's been mostly traded with China, because China's really been ahead of developing those nuclear plants. Because I'm sure, as you covered, we all know this is like 3 to 5 years out before these U.S. plants that we're talking about are going to be up and running.
Yeah.
So this is a long-term bet, and it is a volatile commodity. So, buy when it's at its lows.
Listen, John Najarian likes this. He's come on and sat in that chair. And
I really see a long-term play of China's building more and more nuclear. Now the U.S. is getting on board. Europe has already been on board. And so there's just going to be this constant demand. And we're seeing a stabilization in the base rate commodities. And I think that this is a great opportunity.
Well, in the graduate, plastics, Benjamin, and now you're saying uranium.
Yeah, that's right, uranium.
Rich and Aaron, wonderful to have you. Thank you very much.